If you're not, you're going to be an expert today. Gina, are you back there? All right, Gina's our resident fact checker. Good morning, Steve. So anything that I say that's wrong, she's going to point that out. All right. Please question me, right?
Keeping you on your toes.
It's working, Gina. I studied last night. Maybe we could, I don't know if they'll be able to see the screen with this light on, but really, there's only two examples.
Yeah.
So.
You want me to leave it off, right?
Yeah, is it more comfortable with the lights off for everybody? Or just leave it off, that's fine.
Just don't fall asleep.
It's just fine.
No.
How could they fall asleep during this energetic presentation? Exactly. Good morning, how are you? So Prop 19, ordinarily, when a property changes, there's a reassessment and the subsequent owner is going to be paying tax based upon the purchase price, not necessarily the purchase price, but whatever the assessed value is as derived by the assessor. But there are certain exemptions from reassessment, and that's what we're going to talk about today, and that falls under Prop 19. So rules on tax basis portability under Prop 19. With the passage of Prop 19, a homeowner who's 55 years of age or older, severely impaired or disabled, or their home has been substantially damaged by wildfire, for example, or natural causes, may transfer their taxable value to a replacement primary residence. So Prop 19 replaces the old rules of Prop 60. Prop 60 would allow transfers of a tax value from a primary residence within the same county. Prop 90, which has been superseded also, would allow transfer of your taxable value from a property in a certain county to other counties within the state of California. And I think it was limited to 13 counties, although there's 59 counties in the state of California. So it's very limiting, as a matter of fact. So anywhere within the state of California, if you're 55 years of age or older, you may have the opportunity to transfer your taxable value to a replacement residence. So we'll go through the rules of that, as a matter of fact. And then Prop 19 also superseded transfers in regards to intergenerational transfers. So it's been much more limited now, as a matter of fact. There are exceptions or exemptions available for intergenerational transfers, for example, between a child and a parent, or a child and a grandparent, but there are certain rules that have to be met, as a matter of fact. So remember, you can transfer, or you have the opportunity to transfer your taxable value or tax basis to a replacement residence. You must be 55 years of age or older. And I'm not going to continue to say somebody who's disabled. Let's just make the presumption it's always somebody who's disabled, or if your house was damaged or destroyed by natural causes or wildfire. So you can do it anywhere in the state, and you can do it regardless of the value of the replacement property. However, if the replacement property is greater in value than the full cash value of the relinquished property, there may be an increase in regards to what the taxable value will be. You have to take advantage of this within 2 years of the date of sale of your primary residence, meaning you can actually buy a replacement property 2 years in advance of selling your primary residence, or following the sale of your primary residence, you have a 2-year time frame in which you'll acquire a replacement residence. And there are certain other obligations that you must meet. And this also applies to newly constructed properties too, right? But the date of construction must be complete within that 2-year time frame of the date of sale of your primary residence. So the questions we're going to go through: must the sale of the original property, meaning your current primary residence, and the purchase of the replacement dwelling happen at the same time? No, there's no obligation to do that. Remember, once again, if I buy a replacement property 2 years prior to the sale of my primary residence, that qualifies, because I can convert that to my primary residence, or I can find a replacement property and occupy that property within 2 years following the date of sale of my primary residence. So it's 2 years, before or after. And then, is it necessary for the homeowner to sell their primary residence? Can a homeowner simply buy a replacement principal residence and rent out the original principal residence? Prop 19 requires that you sell the existing primary residence. So I can't move out of my primary residence, designate another property as my primary residence, and have the opportunity to transfer that taxable value. You must sell the existing primary residence. Remember, it's a 2-year time frame in which this must all take place, as a matter of fact. Can I give my original replacement property to my son or daughter and then transfer my tax basis to the replacement property? No, you're not entitled to do that. So there are certain guidelines. Intergenerational transfers, there's a certain exemption that's available to you. We'll talk about that, as a matter of fact. But when you're to take advantage of Prop 19, there must be a sale and change of ownership, and it must be for something. There must be consideration. I mean, you must pay for something. So I give it to my son or daughter. I'm not going to be entitled to take advantage of Prop 19. So it's a 2-part test. Property must be subject to a change in ownership, and something of value must be exchanged. So if we talk about other opportunities in regards to maybe a decedent, and he gives the property to someone, or actually through their estate planning, somebody benefits or obtains title to that property, they're not going to be entitled to the full Prop 19 opportunities. So if I gift a property also, I can't just necessarily take advantage of transferring the taxable value to the replacement property. But there is an opportunity in regards to intergenerational transfers and exemptions associated with that. So we'll talk about that as we go through here. So if the replacement property is purchased or constructed before the original property is sold, can the base year value be transferred at the time of the purchase or construction? So I've acquired a property. I still have my existing primary residence. At the time I acquired the replacement property, can I transfer my base year value? You cannot do that. So 2 things. You must sell the original primary residence, and you must occupy the replacement property. So those are requirements. Questions about that?
So it's pretty much the tax base can only be on one property.
It
At a
can
time.
only be on one property. That is correct. And then properties that are eligible for the reassessment exemption. So that can include a primary residence, or excuse me, a single family home, a unit in a common interest development, a co-op. We have a lot of co-ops in Laguna Woods, as a matter of fact. Remember, in a co-op, you don't actually own the property, you own a stock certificate, but that is eligible also. A condo, a townhouse. Mobile homes are also eligible, whether you own the land or not beneath it. And then also ADUs, or properties with ADUs. So there's an exemption in Senate Bill 539 that allows a transfer of a property with an ADU to fall within the Prop 19 exemption. So if there's an ADU on the property, does that count as an additional unit? Well, typically no. So it's still considered to be a single family home when somebody constructs an ADU or a junior ADU. So in the event I own a property, and we're seeing a lot of properties with ADUs on them, or junior ADUs, and let's say I construct an ADU, I'm occupying either the main residence or the ADU, I can take advantage of Prop 19 by selling that property, because ADUs are not deemed to be separate units. They're not separate alienable units, for example. There's no separate tax bill typically. So if I have a property with an ADU, I can sell that, and that will qualify when trying to apply for the exemption for the replacement property. So once again, just as long as myself, as a person being 55 years of age or older, if I have a property that has an ADU, I must occupy one of the properties within that, so the main residence or the ADU, to qualify. Likewise, if I buy a property with an ADU, I just must occupy one of those units on the property, whether it's the main residence or the accessory dwelling unit. Yes.
Is just give an example of that. For instance, if I have a house that I build an ADU, I live in it, and then I can sell that ADU.
Now, you can't sell the ADU separately.
I cannot.
No, it's not considered a separate alienable unit. So it's all deemed to be a single primary residence, actually, typically.
But don't they talk about it that it can be as a separate
But then you're not going to qualify.
ice?
That's so I would say most people that construct ADUs, when you look at how the property that is designed, it is considered to be a single family residence still. As a matter of fact, it's not considered to be separate units.
But I heard that people can get a title to the ADUs.
You might be able to, but then you're only, if you're gonna have to, if you're living in that ADU, and let's assume, usually what happens, Corona del Mar is notorious for this. So people will construct multiple units on the same property, but typically they're creating condominiums. So that's how they subdivide those properties in Corona del Mar, which you can then sell those individually.
Okay, so for instance, if somebody bought a house long time ago, still they have a different title, or they obtained the title for the ADU.
Mhm.
And because it was part of their unit, so, you know, they.
All the structures on that property are considered to be one single family residence. Doesn't matter if there's more than one ADU. So the legalities of an ADU or junior ADU fall within the realm of the single family residence associated with the original property. So that's why the exemption exists within Prop 19.
Even if they get a separate.
Well, that's a different story there. Yeah, well, to do something like that, you probably have to subdivide it to get separate title associated with that. Now, you're going to have two separate properties. So that's going to be a separate issue, as a matter of fact. But most likely, that's not going to be the case for most ADUs.
Does the lot type matter, R1 or R2?
No, I don't think a lot of time matters.
And for instance, if I do that, how would my ADU be taxed?
It's just going to be an improvement on the property. You're going to get a building permit. They're going to grant that to you. And then because just like any other improvements you make in your property, it's subject to reassessment.
Reassessment, so they're not saying, is that, so as a value of that date?
Well, and when I say, let's assume somebody has a single family home, they add an ADU to the property. There's going to be, when you apply for a building permit for the ADU, there's going to be a value associated with the construction of that
So like
ADU.
development and all of that they would.
Well, it's just going to increase your taxable value of that property for that APN number. That's what's going to take place. Masood, you got a question?
Yeah.
No, Masood did.
Yeah, I was wondering the same thing for like properties that have like four places. Track places, four places, how's that?
Well, you might, if you're, that's a very good question. I may not have the exact answer, so Gina, you might check me on this. I guess it depends how the property is held. Now, if it's an individual in that property, I don't think that if it's a multi-unit building, you're going to be able to take advantage of Prop 19. However, if in the event there are individuals that own a multi-unit building, like a fourplex, and they own it as tenants in common, meaning they each have a percentage interest in the property, and they each occupy a separate alienable unit, they can sell their 25% interest in my example to somebody else and roll that forward into a replacement residence. Now, someone who's occupying one unit out of a 4-unit building may not have the opportunity to roll forward the taxable value. How would that be subdivided? I'm not quite sure.
You have a question up there.
But with that, isn't that sometime when you do have a 4 units, you can live in one?
You can, absolutely,
And
absolutely.
rent the other. So if I do 1035 and get another fourplex.
At 1035, 1031.
1031, I'm sorry.
That's right.
1031. So could it be?
Well, you're not going to be entitled to a full exchange for that property because only 3 out of those 4 units in your example are investment properties, theoretically. So you may not be entitled to perform a 1031 exchange. Well, certainly not for the entire aspect. So the question is, do you think other places outside of San Jose are going to start selling ADUs as separate units? As separate units, no. I wouldn't call a separate unit an ADU. An ADU is just like an appendage to the existing residential property. So that would be just a separate alienable unit that you might sell. I don't think that would not be considered an ADU anyways.
He's probably talking about where they've allowed you to split your lot in two and then build another house on.
But that's just a separate
Yeah,
home.
yeah.
That's really
Probably
how
what it
it
is.
would be defined or characterized.
Is there an attorney that if somebody in the office needs them regarding Prop 19, do you know one? Can we have a reference or?
Yeah,
Yeah,
we're gonna
someone-
pay for it, but,
Yeah, of
yeah,
course, of
yes, absolutely, absolutely.
We have the best attorney. His son.
No, my son is an attorney to CPA. He's a tax attorney, so, yes, thank you. What's that?
You said that it applied 2 years before and 2 years after. So let's say you have a situation where I'm like, for 55, I'm gonna buy a house immediately. So I find the house, I buy a house, but it takes me, let's say, a year and a half. So first primary residence that I was living in, that I began to occupy the new one right away. So am I paying the new property tax on the new one until I sell the second?
That is correct, Gina.
Primary.
Right.
Thank you.
Yeah, you're going to submit whatever forms they are for the exemption, but right, you can occupy a replacement property, but until you sell the original primary residence, you're not entitled to transfer the tax basis from the original or the relinquished property until it's sold.
So I'd be just paying.
Correct. And then upon the sale of the original property, then you can apply for the exemption. Yes, good question.
Okay, so the tax transfer amount, whatever it is, from original to the new one you've been living in for 2 years, it starts applying that tax base from the time you sell the original, right?
Correct.
Sell it, it gets not from, and it doesn't go back to the time you've been living there.
No, it does not.
2 years.
Actually, the date is going to be the later of the date of acquisition of the replacement property or date of sale of the original property or the date that construction is complete. So always the later of, and then you can actually transfer that tax basis. So in Gina's example, she bought a home for 2 million. She's gonna be paying tax on 2 million of that replacement property until she sells the other house, which she has a taxable value of 500,000. And eventually, when she sells a property that's has a value of 500,000 from the assessor standpoint, then she can transfer that to the replacement property.
But only transfer based on the value. If it's 500,000.
The assessed value.
The assessed value,
Yes.
I see, and anything additional, the 2 million compared to, let's say, 1.5, she has to pay the.
Well, no, the question comes down to what is the full cash value of the property that she's selling? So that's what it is. It's not going to be the difference between the assessed value of 500,000 and the full cash value of the replacement property of 2 million.
The sales price.
It is. That's what's going to be this. So if she bought a property for 2 million and the property she sells today, that was her primary residence, sells for 2 million, then she'll just get the full benefit of transferring the 500,000 over assessed value to the replacement property. However, if she sells the current primary residence for $1 million, she's going to be transferring the base value of 500,000 plus the difference between the full cash value of the replacement property, between the full cash value of the replacement property, which is 2 million in our example, and then the full cash value of the relinquished property, which is $1 million. So she's going to be paying tax on $1.5 million.
Okay, what about the scenario that you are selling primary residence, so you still have to pay capital gains if.
Yeah, that's separate and distinct
That's
from our
the-
discussion.
Yeah,
Yes,
okay,
Yeah.
so there are two different.
Correct. Correct.
Processes that one has nothing to do with the other.
That is correct. Correct. So is my example about what the taxable value would be on the replacement property for Gina? So remember, she bought a house for 2 million. Her existing primary residence is being taxed on 500,000, even though the value is $1 million. So she's going to be able to get a benefit of 500,000. She'll take the taxable value of her existing property. We're going to add to that the difference between the value of the replacement property, subtract from that the value of the relinquished property, and that's what you're going to be taxed on. And I have an example we're going to put up here to make it easier for everybody to understand the mathematics, as a matter of fact.
Today's value.
Yes, the full cash value is considered to be theoretically the sales price. It becomes a dilemma when you're buying a replacement property. Is it, are people, let's assume I don't want to have any reassessment whatsoever. And I just want to transfer my property. So I tell the seller, because I'm at that margin, that if I pay commissions, or if the seller is paying the commissions, they're probably going to sell the property for more. So maybe I'm going to now say I'm going to pay my own agent's commissions. However, when you're filing for the exemption, you have the obligation to state whether or not you as the buyer pay the agent's commissions, because that's going to determine the full cash value of the replacement property.
Excuse me, what is the property that she got for $2 million? It's 2 years later, she's selling and transferring the property tag. But is it based on the 2 million she bought, the difference, or based on what that 2 million could be, 2.5 million?
It's going to be based upon the acquisition price as of the date of the purchase. So there's some guidelines actually we'll talk about, that if you buy the replacement property subsequent to the sale of the relinquished property or your original primary residence, the full cash value there's a formula that benefits the property owner who's attempting to transfer this. So we'll go over that.
How many times can the person do
3
this in
times
their
in your
lifetime?
lifetime?
3 times,
3 times.
unless you're disabled or your house has been destroyed by wildfire or natural causes. Then there's no limitation in regards to transferring.
So Prop 19, one of the things that you can get qualified is disability, yes, right?
You can do what now?
So if you're a disabled person, you can take advantage of that Prop 19.
More than 3 times. There's no limitation, Mark.
Okay,
Yeah,
so that's what.
correct. Right. That is the difference. Otherwise, and likewise, if you took advantage of Prop 60 before or Prop 90, that does not count towards the total of 3 times.
So do you know why they came up with Prop 19? Because we had this situation, but one time in your lifetime, right? And then here it comes, and now it's 3 times you can do that. Do you know, is it to make more money for the state with transactions?
I think it's actually to benefit people that may be considered to be senior citizens, because the cost of living is so exorbitant here. So and this is a way probably that also the California Association of Realtors is trying to enhance or increase activity for realtors. As now, maybe somebody whose kids have moved, maybe they want to downsize, and they can actually, and they've been living in their property for 30 years. They bought it for 100,000, now they sold for 3 million. So maybe their assessed value is only 300,000. They can carry that forward and not have any real substantial, any increase in regards to what their property taxes will be.
Yeah, but the 3 times is it could be.
3 times is a lot.
Yeah, the senior could move 3 times.
Yes, you
right?
could,
Keep
you could,
transferring.
right? You
Okay.
could, but that's still,
Activity.
why sometimes the criteria exists. I'm assuming it's always a matter of negotiations. And I think sometimes they're also trying to determine how will that affect the revenue aspects that the state benefits from.
That's what I thought was primary.
Yeah,
Excuse me, you mentioned they do have a window of 2 years, even
what now?
they have a window of 2 years
That
to
is
buy their house.
Huh?
So that 2 years, they can rent their house, the old house, because they live in it the 2 years for the last 5 years, right? That's still applied to them.
That gets back to capital gains, the 2 out of the 5 years. So
Yeah.
that's a separate
That's
issue from this.
separate. So is it okay to rent it?
So I
Or-
can, well, yeah, I can move out of my primary residence, not sell it while I'm searching for my replacement property. I can rent it out. It's just before, remember, within 2 years from the date of acquisition of the replacement property, or 2 years prior, I must have sold that primary residence. So you can rent it out for a year.
So
Okay,
in that 2 years, if you can rent it
Okay.
and live somewhere else on the new primary, it's okay.
That does not disqualify you,
I
correct?
see.
Correct.
Mhm.
some notes here.
Rented or Airbnb?
It doesn't matter. It just doesn't matter what you do with it. Leave it vacant, rent it, Airbnb. There's no issues in regards to what you do with that property. It's just that 2-year time frame. You must own and occupy the replacement property within 2 years following the date of sale of that primary residence. And then, so remember, we're talking about the Prop 19 exemption. And what else do we typically do when somebody buys a property and they're going to occupy the property? There's a homeowner's exemption, correct? So we file for a homeowner's exemption when we're buying a primary residence. What does a homeowner's exemption do for us? All it does is reduce the assessed value by $7,000. So must you file for the homeowner's exemption also? Yes, do that. Otherwise, you may not be protected. That's a way of proving that you're occupying that property as your primary residence.
What did you just say? I'm sorry. Can you repeat the last sentences?
Certainly. So when you're moving into the replacement property, you should also, besides filing for the Prop 19 exemption, file for the homeowner's exemption, which will decrease your taxable value by $7,000.
If you're a couple, single is less.
No, it doesn't matter. No, there's no benefit being single or married. That's just if the assessed value of the replacement property is $1 million, I'm paying tax on $1 million. With the homeowner's exemption, you're going to pay tax on $993,000. You look at your property tax bill, you'll probably see this $7,000 used to reduce the assessed value of your property taxes.
Rich, do you mind holding your hand up so it locks in on you?
Do I have it?
I don't know, hopefully.
Okay. So what about co-owners on title? So there's no limitation in regards to how many co-owners can be on title to take advantage of Prop 19. And then co-owners such as joint tenants, tenants in common. What about married couples? Well, just as long as one of the individuals is age 55 or older, as of the date of sale of the primary residence, you can qualify for Prop 19. So the key number or key date is, first of all, age of 55, and then the date of sale. If I'm 54 and I sell their primary residence, I'm not going to qualify. One of the owners must be at least 55 years of age or older to qualify.
Does that include the purchase of the replacement property?
No, it does not. You can buy the replacement property 2 years in advance, and there's no obligation to be 55 years of age.
Okay.
So you can be younger. You could be 53, theoretically. Buy it at age 53 on your birthday, sell it on your birthday at age 55.
So everything kicks in at the sale.
It's predicated upon the sale of the primary residence, exactly. And what about if there's 2 or more co-owners of the original property and they construct 2 separate units? Maybe it's a married couple. They don't want to live together anymore. Only one of those individuals can take advantage of Prop 19, even if they both qualify. And then I think we talked about this example. If there's more than if there's 2 or more co-owners, can they take advantage of Prop 19? So if it's a triplex, for example, and it's held as tenants in common, they each have a 33% interest in the property. If one of the individuals sells their 33% interest, they can then take advantage of Prop 19. Or all 3, if they sell the building, they can buy their own respective separate units, assuming they meet the criteria of being 55 years of age or older. They can also take advantage of Prop 19, transferring their tax value. We talked about 3 times. And then married couples, only one of the individuals must be 55 years of age or older at the time of sale of the primary residence, the existing primary residence. So just to once again, go over the details. So the critical date for the age 55 requirement is the date of sale of the original property, not the purchase of the replacement property. The replacement property can be purchased within 2 years before or after selling the original property. And as long as the spouse claiming the exemption is at least 55 years of age or older at the time of selling the original property and is entitled to both properties, the transfer is allowed. So the person that's 55 who sells their property must also be on title on the replacement property.
Would you please say it again? The
Sure.
person who is selling it and in all the,
So it's a husband and wife. The husband's 55, the wife is not. So they sell property, existing primary residence, and they're going to buy a replacement property, or maybe they're not going to live together. Well, maybe they want to have separate properties. The 55-year-old who sold that property must be on title on the replacement property.
oh,
And likewise, let's assume there are multiple owners of a property. You don't have to be occupying the property. Not everybody has, there could be 5 owners of a property. Maybe one individual is 55 years of age or older and he's occupying the property. The other 4 owners are just maybe investors. They can sell that property. And just as long as everybody that's on title on the relinquished property also is an owner of the replacement property, and the same person that's 55 years of age or older occupies their property as a primary residence, they can take advantage of Prop 19.
so really the way it works, if I bought a property for 200,000 and I bought it and I sell it for 1 million, so I can buy a replacement property for another 1 million and not and pay the same tax and that I was paying before.
That is
But
correct.
if I pay, if I buy something more, so I have to pay taxes on a difference.
That is correct. That's great. Very good. Very good. Let's see. And I do have an example to go through that just to clarify that in case there's any questions about that. So does the taxpayer get any property tax relief if the replacement dwelling is not of equal or lesser value? So under Prop 19, the taxpayer who is 55 years of age or older, they can transfer their principal residence anywhere in the state. So remember, this is not qualified. You're not qualified if you're moving out of state. So just to eliminate that. If the acquisition price of the replacement property is greater in value than the selling price of the relinquished property, then you're going to have an upward adjustment in regards to what the taxable value will be.
I heard it can be up to 110, 20% of the property you sell, the new one.
As a matter of fact, you're absolutely right. And that's part of my presentation. I was gonna, no, it's just, you just hit my next point.
Okay.
So the equal or lesser value. So this is how it's defined in Prop 19. If I buy a property before I sell my existing primary residence, just as long as I don't pay more than 100% of the selling price of my existing property, I can transfer the taxable value. And I'll have put an example up here, by the way. If I buy a property within 1 year following the date of sale of my relinquished property or my primary residence, just as long as the purchase price of the replacement property does not exceed 105% of the relinquished property, I can transfer my assessed value without any upward adjustment in regards to what my property taxes will be. And just as you said before, if within year 2 following the date of sale of my primary residence, I can buy a replacement property, and just as long as it doesn't exceed 110% of the selling price of the former primary residence, I can transfer my taxable value. And could you put that example up there, please, Carlos? I do have an example, just to clarify that. Okay, so let's say the original primary residence closed January 1st, 2025 for 500,000. I sold my primary residence. Replacement property is equal or lesser value if it is purchased within 2 years prior to that at no more than 500,000. So I sold my property January 1st for 500,000, but before that, I had purchased a replacement property and I spent no more than 500,000. I can transfer my taxable value from the property I just closed January 1st to the replacement property. And then if the replacement property is purchased or constructed on or before January 1st, 2026, remember that's 1 year following the date of sale of my existing primary residence, then its full cash value should be no more than $525,000. How do we calculate that? It's simply 105% of the selling price of the relinquished property. So 105% times 500,000 is 525,000. So if I buy a replacement property within the year following the date of sale, and I spend no more than 525,000, I can transfer my assessed value to the replacement property. And then in year 2, I get another benefit. Just as long as I don't spend more than $550,000, I can transfer the assessed value from the relinquished property. So the math is simple. It's 110% times 500,000. 500,000 is the selling price of my primary residence. That's 550,000. So if I buy a property between year 1 and 2 for $550,000 or less, I can transfer my assessed value from the relinquished property to the replacement property. Any questions about that? You do? Yes.
So you're saying, like, within 2 years, let's say 2 years prior to the date of sale of the property, within that 2 years, they pay the same tax of that 500, and then once they sell this property, they kind of retract it, go back to the original tax.
Yes. You're right. So I'm paying tax on 500,000. That's the home I'm living in currently.
Yeah.
But before I sell that one, you're saying that within that 2 years prior, I buy a property for 500,000. You're going to be paying tax on the full 500,000
2 years.
for 2 years, whatever it is, until you sell what was your primary residence. And maybe the assessed value in your primary residence was 100,000. But once you sell that and occupy the replacement property, then you can transfer that $100,000 assessed value.
Can you buy the property 2 years before as a primary residence, but you're still living in your primary residence, you're renting the replacement property for 2 years, and then you sell and you move, can you still do that although the property was bought rented for 2 years?
Yes.
Sometimes, okay, instead of renting the primary residence, you're renting for 2 years the
Replacement property. Right.
Okay, you still can do that, doesn't matter if it's rental, either home rental for 2 years.
That's not that right. You'll still qualify for the Prop 19 exemption, as a matter of fact. Correct.
That's right. Okay,
Yeah, so it's good planning, actually. You buy that replacement property in advance. Maybe you want to downsize. That's the whole advantage of Prop 19, as a matter of fact. Maybe you're just not ready to move yet. Might be moving to the beach, smaller residence, right? More expensive. So you really have some benefits there associated with it.
are you going to get into intergenerational? Because I've heard if your child lives with you for, I don't know, for a while, in the house with you when you pass away, or she can get the property, although it's in the trust, and she's living with you, so she can write out, get it, and doesn't have to worry about Prop 19 condition or requirements.
Yeah, I will talk about intergenerational transfers, but I will address that. So parents own the property, daughters living with the parents, right?
Mm-hmm.
That's the parents' primary residence. They can actually gift that property to the daughter. So remember, a sale, or to typically qualify for Prop 19, it must be a sale for consideration. There must be money changing hands, as a matter of fact. But in this case, the parents are going to give it to the daughter.
Right.
And then the daughter, within 1 year from the date of the gift, must occupy the property and claim it as her primary residence.
So you can gift it while you're living in the primary residence.
Good.
Isn't it reassessed though after it changes?
Well,
See, that's what
ownership?
the reassessment of property does.
there will be a reassessment because of the change in ownership. But the only benefit that you get with intergenerational transfers is $1 million reduction in regards to what the taxes would be. Not taxes, but the assessed value. So let's assume mom and dad bought it for $2 million. and then they gift it to daughter. And as of the date of transfer to daughter, the property is worth $4 million. So there's $2 million more in assessed value. If the daughter occupies that property within 1 year following the date of the transfer, she's going to get a benefit of $1 million reduction in regards to the assessed value. She would be paying taxes on $3 million.
That's a big problem.
So it's up to 1 million.
Yes, up to 1 million, but you will never pay less than what the prior assessed value was.
Mhm.
And then the
But
problem is,
Anytime that the person move out of that house, the tax rate will change.
it will change. So once daughter moves out of that house, if she moves out, then it's going to be assessed at the full value.
So there is no way to have a situation with your children to give the house and still they can keep the same tax basis. I heard there's some tricks in here that can happen.
I'm giving you the tricks because Prop 60 and Prop 90 are gone. So intergenerational transfers have been dramatically modified. That's the problem.
There used to be.
Yeah.
The
There
state
used
wants
to be.
money.
Yeah, there used to be. So maybe the trick is if it's a sale for consideration, then that's not considered to be a gift or device. You could do it that way. They're gonna have to pay. They have to actually show that it's a sale and probably for what the value of the property is. Otherwise, when you apply for the exemption, the assessors, in our example, let's assume the house is worth 4 million and daughter pays $1 million. The assessor's probably going to be questioning that and not permit that to allow the Prop 19 transfer.
Yeah, I heard that's kind of a stuff cannot.
Yeah.
Price has to be similar to what's the value, yeah.
One other way the kids can benefit is if they leave they're the beneficiaries after the parents pass away. They
Yes.
get the house, they sell it, they don't have to pay taxes on any of it, right?
I'm sorry, I wasn't
Yeah,
listening. I'm sorry.
Yeah, so if a kid is, one of the kids is a beneficiary after the parents pass away, they sell the house right away, they don't pay taxes on any of it, right?
Well, they would get a step up in basis. And that's why I would never suggest that parents just give the property to
Yeah.
their children if there's a substantial capital gain in there. Because as of the date of death, if the property was originally purchased for $1 million, as of the date of death, it's 4 million. And then daughter inherits the property. Her cost basis is for tax purposes, for income tax purposes, will be deemed to be $4 million. So if she sells it for $4 million, she's not going to have any tax liability.
That's the way to go.
That's the way to go. Yeah, it's just not worth it giving property to somebody and from a tax standpoint. Yes, because the person that's receiving the gift also takes with that property the donor's tax basis in the property.
So the best pay from capital gains or any kind of tax or consequences is that the property is in the trust and the beneficiary sells it right away at the date of the.
Well, they don't have to sell it, but the valuation for whatever the cost basis will be based upon the date of death.
What if they decide to move into that property and keep it?
But they could, but that's just it. Now when daughter moves into that property, if she sells it, when calculating capital gains, her cost basis is now going to be at $4 million in our example, instead of mom and dad's cost basis of $1 million.
Okay, so she pays the same property tax mom and dad pay?
We're
No.
two different things. Capital gains have nothing to do with property taxes. So if we're talking,
Right, I
forget the
understand.
property
I'm
taxes.
talking about property tax, when the child moves in.
When the child moves in,
property.
they're going to get the benefit of $1 million exemption or reduction in regards to what the assessed value is going to be. Yes, well, still, in that case, they're paying taxes on a $3 million home instead of $4 million. So there is a pretty dramatic benefit in our example.
Right parent. Parents pass away, house is in a trust, it's left to 4 children equally, multiple children. The one child decides to come and live in that house, even though it's like 4 people own the house. Does that one child still get that $1 million benefit?
Yes, just as long as they occupy the property as their primary residence. And if that child moves out and one of the other children moves in, they can still get the benefit of that $1 million reduction in regards to the assessed value. But as soon as one of those 4 people no longer occupies the property, it's going to be reassessed to whatever the market value is.
Yeah, can't.
You cannot turn it into a rental property. Yes, correct. Cannot turn it into a rental property, otherwise you lose any benefit.
Parents, property taxes because of the suppression of property taxes over a long period of time. So they only over an assessed value of $1 million. But by the time they die, it's like worth $4 million. But they get a 1 million exemption if the child moves in. Then they be paying taxes on how many millions?
3 million, 3 million, assuming they occupy the property. See, that's the problem when somebody, these people that have accumulated property and now they're deceased and the children are the beneficiaries of that. If it's rental property, it's just reassessed to the full value. So suddenly now they're hit with these major tax bills and these rental properties don't make any sense anymore.
Record, I voted against this bill.
Me too.
Do you hear a second?
Yeah, yes, oh yeah,
That's why they,
For you.
that's why the state did it for their budget.
For the money,
purposes. They
yeah,
keep
yeah.
getting more money. every
Exactly.
time This
I have a
taxes.
question regarding that she mentioned that it's a 1 million, but if a person pass away, so because of the step up taxes.
okay.
That they have a 9 months to sell the property and pay the capital gain,
No, there's no obligation to sell it, no,
or
they don't have to sell it.
they don't have to
No.
sell it.
The only limitation that I'm aware of is if it's a married couple and one of the two spouses dies, if the surviving spouse wants to take advantage of the $500,000 capital gains exclusion, they have a 2-year time frame in which they must sell the property.
Yeah, but.
But no, there's no 9-month time frame.
9 months for the settling the estate is not.
No, there's no obligation. I think what happens, we see a lot of times. Someone dies, someone inherits the property, and then they're going to sell it 7 years later. Now, nobody really knows what the assessed value was as of the date of death. And it's more contestable if you go back to perform an appraisal based upon a property or a time frame 7 years in the past. So I certainly suggest, in the event there is a situation like that, when the people that own the property die, the beneficiaries should, within a practical, reasonable period or short period of time, have the properties appraised now. It's probably not going to be contestable then. But if you wait 7 years to have the property appraised, so many things can change with the property itself. Improvements, things like that, who knows?
So after Prop 19, then what is the advantage of keeping properties and people have keep properties to pass dying, leave it for their children? What is the use of that with all, because children may not be able to then pay their new assessed property taxes.
That's the problem.
It's a waste.
So why aren't there more home for sale since
Well,
19?
It's probably, first of all, I think it's forcing a lot of people to sell properties that they may not have sold simply because the increase in property taxes. But what it's doing, at least from maybe one perspective, there's more property coming on the market because of it. It creates more transactions.
Something, oh yeah, it was, they knew about Prop 19 and what they did is
Before it took place, yes.
They did all this stuff.
Yeah.
So they,
But that goes back to April 2021.
yeah.
This
So,
is
yeah.
a coalition against intergenerational transfers within, so like wealth building within the state of California. So it's against that effort, unfortunately.
Yeah, and that obviously didn't.
I mean, they're paying higher property taxes, but they don't have a mortgage payment, so.
What was that, Gina?
Yeah.
Yeah. But the beneficiaries of a substantial estate, they're not happy about it because the property taxes are substantially higher now. These properties that were accumulated over time. Shweta, did you have a question before?
So I was just asked, I wanted to just ask, like, if it's a 4 million tax basis, like if they don't decide to make it into a primary residence and but as a rental property, then instead of having a tax basis of 3 million, it'll still be 4 million.
That's right.
And so it's only a $10,000 difference in tax.
$10,000 to me is a lot of money. To you, it's nothing.
Hold on.
The rent on a $4 million is still probably worth it for someone who's inherited.
But that's not the case. No, the real case is they're paying tax on 4 million, that the decedent was paying tax on $1 million. So now they're paying $30,000 more,
Okay,
or at least 20,000 more. That's the real issue. Yeah, it's a lot more, exactly. That's the real problem, as a matter of fact. Would you move that up? And this is repetitive. We talked about this.
But they don't have a mortgage.
They don't have a mortgage. What's that?
You're paying higher taxes, but there's no mortgage. And you have this big house with no mortgage and you.
Sometimes the rentals just don't support it.
Yeah.
That's really what it comes down to. The rental may not support all the additional expenses.
Oh, this is for rental.
No, that's what we're talking about.
Yeah.
Yeah, if it's a rental. So now, just to go through an example. So let's assume the original property had a taxable value of 500,000. The original property sells for, can everyone hear me? Excuse me. Hello? No, you're not. Thank you. Suppose the original property sells for 900,000, but the replacement property was purchased for $1 million, right? So what is the taxable value going to be for Prop 19? So we're going to add the taxable value of the original property of 500,000 to the difference between the purchase price of the replacement property, subtracting from that the taxable value of the relinquished property, and that's 100,000. So essentially, we're going to be paying taxes on $600,000. That's where we're going to be. So you may not get 100% benefit, but you're going to get a substantial benefit according, associated with Prop 19. And then remember, the adjustment for Prop 19 takes place the later of the date the original property is sold, the later of the date the replacement dwelling is purchased, or the date of construction or completion of construction. And then what if somebody doesn't want to transfer their tax basis using Prop 19? They have no obligation. You actually have to file for the exemption. So we talked about intergenerational transfers. What we didn't talk about are transfers between grandparents and children, parents and children, or grandparents and grandchildren. So they can go either way. A child can actually gift a property to grandparents, so that's eligible for that $1 million exclusion also. However, our grandparents can gift to the grandchildren. However, for the $1 million exemption to be available, the parents of the children must be deceased. So it's kind of macabre, huh? Morbid. So it can go either way, as a matter of fact. And this is only for intergenerational transfers. Once again, it's only for a primary residence. And then it must be the parents' place of parents or grandparents or child's primary residence. And then the person who's getting the benefit of the property must also occupy the property. They must occupy their property within 1 year following the date of the transfer. So if grandparents die, they gift it to their grandchild or to their children. They must occupy their property and file for the exemption within 1 year following the date of transfer. And then remember, if the beneficiary moves out, they lose the exemption and you're paying tax on the full assessed value. And we talked about, if in Gina's example, if there are 4 beneficiaries or owners of that one property, just as long as one occupies the property, you're entitled to the Prop 19 benefit or the benefit associated with the intergenerational transfers. Let's see. I think we're almost done there.
What site has all the detailed legal and examples?
All the examples, well, I use the California Association of Realtors site, but it does not cover everything. So the Board of Equalization, the BOE, actually has much more detail in regards to other aspects of this, as a matter of fact. So that is a wealth of information. Then a couple of other things, interspousal transfers, transfers between spouses. Is that subject to reassessment? Or is it exempt from reassessment? I just transfer my interest in my property to my spouse.
The transfer.
Is that subject to reassessment? It is not. That's an exception. Very good. And then transfers between ex-spouses, is that subject to reassessments? Well, if it's according to a divorce decree, no. But if there's no divorce decree, then it will be reassessed. Transfers into or out of a revocable trust, that is not subject to reassessment also, just to bring that up. So that's the end of the presentation today. Anyone have any questions? So what are we going to do with this? This is a way to market to people, especially to people my age. Notify them. They may not, a lot of people really don't understand that they actually have this benefit to sell their primary residence. You may want to downsize, buy a replacement property, and carry with them the assessed value of the relinquished property. That is probably one of the best things that we could be doing to helping people, as a matter of fact.
Question if you're right.
There is a question?
Yeah.
And you can probably get relatively accurate information through title to give some idea as to what the age category is of property owners. So you can market to them directly.
Is there something in the big beautiful bill that eliminates capital gains taxes for seniors selling their property?
The answer is no. There's no benefit in the big beautiful bill eliminating capital gains taxes for senior citizens. There have been discussions of possibly increasing the exemption from, from $250,000 or $500,000 or to more, or maybe eliminating it completely. But obviously, if they eliminate that, that means less tax revenues coming in, and they're going to be searching for revenue from other sources.
They should increase it for sure.
Oh yeah, well, the other states.
The 250 for the longest time and the home prices have
Yeah.
increased.
Well, when my parents died 10 years ago, they bought that house for $35,000. It sold for $165,000, and that was 4 years later. That's in Ohio. So people living there aren't as concerned as we are. They haven't experienced the amount of appreciation that we've
This is
experienced.
California or New York or
Yeah,
out there.
these few states, right?
Yeah.
These coastal
It's the
states.
state, Yeah.
But so the other people don't want to do that, as a matter of fact. I think more of the Midwestern states aren't as interested in regards to doing something like that. We don't want to supplement our taxes here.
Besides, California, rich states, they do want that capital gain.
Of course,
They
I want it, right?
increase this.
I think it would be great, but it just isn't happening at this point in time. Okay, everybody, thank you for coming today. Appreciate it.
Thank you
Must mean it's over.
so much.
A lot of good questions today. It's good.